Today we're going to compare my free investing portfolio that was created by a computer to a hand-catered portfolio from a financial professional that over its lifetime will cost me over $100,000 to see if paying for expensive investing tools and advisors is really worth it. All right, let's jump right into it. What is going on, everyone? I hope you are all having a fantastic day. So today I want to help you figure out if you need some fancy financial professional to create a portfolio for you, or if the free and simple strategies that I often talk about here on the channel truly are able to stack up in the long run. So we'll be comparing my very own Wealthfront portfolio that cost me nothing and was created by a Robo-Advisor, also known as a computer, to a portfolio from a company called Personal Capital that, with the fees and minimum investing requirements, will cost me several $100,000 over the course of my long-term investing. Now, neither Wealthfront nor Personal Capital are sponsoring this video, and I do personally use both of these products. However, this is not a comparison of these platforms. It is a comparison of a free portfolio to a very expensive investment portfolio. All right, so first let's start off with my personal Roth IRA, which cost me nothing and was made entirely by a computer with no human intervention. Now, before you all go firing off in the comment section, yes, I am aware that Wealthfront has a management fee of 0.25%. However, full transparency, I've referred a lot of you to this platform and therefore have accrued a large amount of management-free dollars. But don't worry, I understand that that is not applicable to your average investor and user of this platform. So in today's comparison, I will be accounting for that management fee, and we'll even discuss the tax loss harvesting features that Wealthfront uses to offset that management fee. So in this portfolio, the Robo-Advisor has invested my money across US stocks, foreign developed stocks, real estate, emerging markets, foreign market bonds, corporate bonds, and keeps a little bit of cash on the sidelines as well. And you can also see the breakdown by percentage of my portfolio here, with US stocks being by far the largest sector at 33%. And specifically, if we click on that sector, you can see that they are investing in VTI, which is the Vanguard Total Stock Market ETF. For foreign development stocks, which is my second largest category at 22%, they're investing in VEA, which is the Vanguard VTC Developed Markets ETF. And if you do want to see a full line-by-line breakdown of this entire portfolio, I will link to a video that I made doing just that down in the description below. But over the past 5 years, which is about when I started investing in this particular portfolio, it has averaged an annual return of 10.03%. And since this portfolio was created in 2013, it has averaged an annual return of 8.28%. So that's a fairly decent return for really any portfolio, but there are a few really important features that could save you tens of thousands of dollars in the long run. Again, these are features that Wealthfront specifically offers, but really any robo-advising platform has very similar features, and perhaps my favorite is what's called tax loss harvesting. Now, without boring you to death, essentially the computer is going to strategically sell certain investments when they are at a loss in order to offset the taxes that you owe on your profits. That might sound super confusing, and honestly it kind of is if you are just a casual investor, but again, the beauty about having a computer do everything for you is that you don't have to do anything. They are also going to automatically rebalance your portfolio for you to make sure that your sector allocations remain in balance, and if you decide to do so, which I do recommend, they will also reinvest your dividends, which can significantly increase your average annual return over longer periods of time. Now, one other thing I do want to mention is, regardless of where you invest in certain ETFs or mutual funds, whether that's through an advisor or you go and do it on your own, there are oftentimes fees associated with specific ETFs. However, that is going to apply no matter how or where you buy those particular funds. And like I said earlier, the Robo-Advisor that we are looking at specifically in today's video does charge a 0.25% management fee. However, you can get your first $5,000 managed for completely free if you are a new user. So I will leave a link in the description below if you do want to sign up. But as you'll learn in a second, even if you have to pay that 0.25% management fee, this is nothing compared to what the human professional advisor is going to charge, and the tax loss harvesting feature offsets that fee for like 90% of Wealthfront's users. But the big question is it worth paying the higher fees, and are the returns that much better? Well, let's take a look. Obviously, every portfolio is going to look a little bit different because if you hire a true financial professional, they are going to sit down with you and hopefully learn more about your investing goals and where you're at financially in general and create a catered portfolio based on your responses. So what I've done is pulled my own portfolio suggestions from Personal Capital and my advisor at Personal Capital and compared them with the averages for their higher tier clientele through their premium investing service that requires at least $100,000 in investments. And up to your first $1 million, that premium service currently costs 0.89% each year, meaning if you built up a substantial investing portfolio of hundreds of thousands or even millions of dollars in the long term, at 0.89%, you're looking at potentially tens of thousands of dollars each year once you get into those larger numbers. I will mention that in the case of Personal Capital, the fees do get lowered slightly as you get more and more invested, but at that point we're talking about multi-million dollar increments. So for the case of today's video and today's comparison, we'll keep it to that sub $1 million portfolio. So similar to the free example that we just looked at, this premium investing service offers several portfolio options such as aggressive, balanced, a growth portfolio, moderate, and several others. So for a fair comparison, since we are in a higher risk score or a more aggressive portfolio with the free example, we're going to look at the aggressive portfolio for this premium example. So this particular portfolio has 60% invested in domestic equities, which is a fancy way of saying US stocks, 25% in international equities, and a much smaller percentage in things like domestic and international fixed income assets, alternative investments, and cash as well. So the first thing that probably sticks out to you is the fact that the investment in US stocks is nearly double what the aggressive portfolio from the free example is. Whether that's a good or bad thing is totally up to you, but if we look at the annualized return, which in this case is over a 30-year period, it states that it has averaged 9%, which is pretty good over such a long period of time. Obviously, it is not fair to compare that 9% to the 10.03% number that we looked at earlier, because that was just over a 5-year period, and this is over a 30-year period, which included one of the largest market pullbacks in modern history. But if we take the annualized returns with those percentage breakdowns over just the last 5-year period, it averages out to just 7.4%. And with the limited data that I was able to access with this portfolio, those are returns starting in 2008 and going for 5 years after that, which, as a lot of you probably know, was a pretty steep recovery for a lot of industries across the board because of that insane pullback in 2007 and 8. So for the sake of comparing apples to apples here and giving you a final verdict, let's say that you invested $100,000 at the start of that 5-year period and made no additional contributions to your portfolio. Well, with the professional hand-picked portfolio, you had that average annual return of 7.4% over 5 years, and that portfolio cost us 0.89% each year. Again, removing the various fees that specific ETFs and mutual funds may charge. So that means that after 5 years, our $100,000 would turn into $142,896, but we would have to pay $5,823 in fees over those 5 years, meaning the professional hand-picked portfolio would turn into $137,073. Honestly, that's not that bad for such a short period of time, but if we take our 5-year return of 10.03% and the fee of 0.25% from our less expensive portfolio that was created by a robot, this would turn into $161,270, and even after paying $1,823 in fees over those 5 years, we would still be left with $159,446 after 5 years, which is $22,000 more than the much more expensive professionally hand-picked portfolio. Obviously, we have limited data to run these accurate numbers off of, and that's why we're only able to look at a 5-year period. However, if we were to extrapolate those numbers over, say, a 40-year period with that same principle, the fees and returns that we just talked about, then the professional portfolio, after subtracting fees, would amount to $1,246,279. And again, that's after subtracting nearly $500,000 in fees. Meanwhile, the less expensive portfolio created by a robot would amount to a staggering $4,177,000 $621, even after subtracting all of the much lower fees. That's a difference of nearly $3 million over a 40-year investing timeline. And obviously, the numbers speak for themselves. However, I am well aware that there are a ton of unknowns in this example that I'm giving, and obviously we are making a lot of extrapolated assumptions. There are fees that we are not able to account for, the obvious advantages of having a real human in your corner, and a ton of other variables that are simply not accounted for in this particular example. So in today's example, our Robo-Advisor definitely beat the hand-picked, very expensive portfolio by nearly $3 million. But of course, these are just the numbers that I crunched today, so I'd love to know what you think of this debate down in the comment section, and whether you prefer a hand-picked portfolio with a professional in your corner, or you'd rather just keep it really simple with the much more affordable Robo-Advisor like Wealthfront. Again, you do what you want with your money, but if you do want to sign up for Wealthfront, I will leave a link down in the description below, where again, you can get that first $5,000 of investments managed for completely free. Be sure to hit the like button and subscribe to the channel if you'd like to help support my channel, and check out some of my favorite financial tools down in the description below, many of which will give you some free money when you sign up. And of course, thank you so much for your time. I really do appreciate it so much. Take it easy, and I'll see you in the next one.